Q4 2025 Fear and Greed Survey from John Burns Research and Consulting and CRE Daily, sponsored by InvestNext. Well, that's a lot of for a lot of groups put this great report together, but I think they do a really good job over at John Burns Research and Consulting, as well as the CRE Daily. I'm a fan of both. Kind of the big news is of the index. Out of 100, it's at 58, which means we're expanding and things are trending in a positive direction. Now, this is a survey that is comprised of industry professionals, owners. I think 32% from owners, and general partners, some operators. So it's a lot of decision makers that are deciding whether they're going to invest more or less into commercial real estate. A lot of multifamily folks, but they've kind of balanced it out for a variety of asset classes, including industrial, retail, office, and other. And it's really from across the country. Really a pretty even response rate from different states and different regions. So a pretty good kind of assessment of kind of the state of the market according to investors. And so what we've seen here is definitely a tick up in terms of the towards the greed corner, which would be absolute greed would be 100, and fear would be 0. I think this survey is only about a year and a half old, so they don't have that much data. Right now, they're looking back at basically Q1 of 2024. But so it's going to be more useful as time goes on, as we get through multiple cycles. But the biggest change that I saw here is the access to CRE Capital Index moving from in the third quarter of 2025 to 43, which was a jump up from 39 in the second quarter, all the way up positive to 52. And so basically this shift is essentially saying that last quarter, people thought it was challenging to raise capital for commercial real estate. During the fourth quarter, that shifted. More people are saying it's easier to raise capital than it was. The capital is available. Investors are starting to get off the sideline. Griffin, does that line up with with the conversations that you have had? And we had a successful fundraise in the fourth quarter. Well, ended in the fourth quarter.
Yeah, it did.
For Flats and Stones Crossing, our latest multifamily investment that we raised capital from accredited investors. We were surprised with the amount of family office demand and retail demand, less institutional. Does this line up with what we saw, or just curious your thoughts on some of these levels?
Yeah, I think first and foremost, it's obviously it's a great thing to see as we go out and fundraise for deals in 2026. It's the largest uptick on any of those graphs in regards to magnitude, and so it really does depict, I think, what we were seeing across a lot of our fundraising as we entered into Q4, and then again as we traveled to some of these events for truly networking and capital raising purposes. Where in the front half of the year, even in Q3, we would go to these events and people are kind of steady and comfortably positioned on the sidelines, waiting and trying to be as patient as they could for the right operator, the right deal. It seems more and more now as we talk to investors, whether it's here at Great Capital in regards to a retail investor or a family office, they're always looking for ways to invest their money, but there wasn't a lot of action being taken.
Yeah.
It seemed like people were kind of circling the wagons and window shopping. I think that there's a lot more trigger pullers out there currently, people that are actually writing checks, and I think that gives me, at least personally, a lot of encouragement and enthusiasm as we see transaction volumes pick up. We're talking to here Jay in the office about all of the opportunity that may present itself in 26. It's also good to see people are willing and looking forward to, or more encouraged to write checks. So let's hope that the opportunities present themselves.
I was going to say that's the key, is the opportunity, because I would agree with you. A lot of investors are ready to go, ready to write the check. They've got the checkbook out and they're ready for the next deal. But there's not the next deal. And even if you really dig around and you ask, we've ramped up our direct outreach to owners, sending letters, direct mail, like not just emails, but we are snail mailing every single owner in the regions that we're targeting, trying to just shake anything loose.
Yeah.
And we don't typically do that because a lot of our deals are larger, more institutional size deals that almost always go through a broker, but we with an absence of deals, we have to try everything to try to find an opportunity. But it's frustrating to have potential capital lined up,
Right.
which does not last forever, but there's no deals to place it in.
Correct. That, or you're in the midst of cultivating a relationship for maybe a first-time investment from a
Yeah.
large institutional allocator, a programmatic partner. You've gotten to the point where they just want to see a live deal.
They want to see
To
something.
be able to talk through it, see how we see the market, see how we see the asset, kind of poke holes in it and see how we respond. Even when we get a deal that doesn't pencil, it's super challenging to send that over because we simply don't have any confidence in going after it. So why would we go through that exercise in futility?
Yeah, here's a deal that we don't think looks that great.
Right.
Here, spend your time on it.
We want to talk about that with you. It makes no sense. So it is tough to continue to cultivate those relationships when there's not actionable deals, really coming across our desk, or few and far between at least.
Yeah, a little bit more confidence in the retail sector compared to any of the other commercial real estate asset classes. Industrial is also looking pretty good. Multifamily is falling a little bit behind, but really just, again, multifamily out of the whole index, 59. Industrial is 60. Retail is 61. So all pretty close. Office, not surprisingly, really lagging. Only, but it is above 50%, or above the 50 mark. So it's at 53. So there is a little bit of a bid for office. I think there's a lot of folks that are just really curious and they want to buy office or curious about office because it's the one asset class that you can get a meaningful discount in. Like we talk about, I'd hate to buy office, but if it cash flows when it's 40% occupied or 50% occupied, that's starting to sound like a really interesting deal because maybe I get it to 60% occupancy, 70%, and then I've got a lot of cash flow. And if there's ever cap rate compression, you could be really sitting on a winner. This was an interesting one, and I don't necessarily say I disagree, although I think it's a pretty noisy environment, and these are surveys. According to the survey, investors indicate that multifamily and office asset values fell year over year. Not saying it fell by a lot, but by a little bit. Basically, it's been declining by about 6% a quarter in multifamily for the last several quarters. The industrial has been flat with a little 2% lift in Q4 of this year. Retail, mostly positive, 1 to 2% lifts every single quarter. Office, really bad. Negative 31% back in Q4 of 23, but not nearly as bad as it was. It's had a steady kind of like increase of less negative 5% value change year over year on office. That's good. I mean, again, after falling, that's some. Again, these are quarterly opinions of year-over-year changes, so it's not like these percentage points compound completely, but still, that's a lot of decline in at least perceived value. Let's move on. There's an idea that values may fall a little bit more in multifamily in the first half of 2026. That tracks for two metrics that I'm thinking about. One, we've got slow rent growth. We're going to keep talking about that. That's related to huge oversupply. We've delivered more apartments than we've delivered in 40 years. Looking at the Yardi Matrix report that we're going to talk about in a second, there's still 500,000 units in active lease up. 500,000 units. Prior to the pandemic, we were delivering like 300-some thousand units a year. We still have 500,000 that we're actively leasing up. So this narrative that supply is falling or has fallen off a cliff, it just really doesn't kind of match up to the reality. And we've got some more data on that. Again, it's not all bad news. It's just that it's not you're going to flip the switch. You go from negative 1% rent growth to 5% rent growth. It's just not going to happen, at least on a national basis with any kind of business plan. Yeah, so we did tick up. I think this was, for the overall, everybody's ticking up above 50, which is good. And people are generally optimistic about commercial real estate. If we go back here to whether folks are going to increase or decrease their exposure to commercial real estate, I don't think it's an exact analogy of like buy, hold, sell analysis, but sure. I think it's the closest thing that we have to it. And basically, 91% of the market is saying they're either going to hold or they're going to increase exposure.
Right.
Only 25% in Q4 are saying absolutely we're looking to increase exposure. 64% are saying we're going to hold. I'm not going to change my exposure. But there's only 11% that are saying I'm going to sell. Mm-hmm. Now maybe they're saying that because it's just a bad time to sell, and they want to sell. They got to wait to sell, but they're not planning on it happening anytime.
Right.
Soon.
I appreciate the quotes there on the right side. Just the kind of an insight as to, it's obviously only two perspectives, but the cost of capital and debt, kind of still eating away at the interest to increase exposure, but also just the individual that had that quote there in the yellow, the overbuilt in his area, and it's interesting as we talk about the supply that we're still having to manage and kind of deal with. Obviously, this is asset class agnostic, but here in the Midwest, many of our markets are just simply not overbuilt, and so we don't have that challenge, or at least at the level upon which other markets do.
And it's interesting, again, the Yardi report gets into more of the actual numbers and the reality, but the markets that are currently oversupplied still have more supply coming. Mm-hmm. It's not like those markets have seen the sharpest declines in starts and construction activity. They're seeing declines from their peak, but it's still well above other parts of the market. Whereas like the Northeast or the Midwest, which saw the least amount of new supply, still records relative to their own history. But, that's where the supply really has been coming off. When I look at, again, Indianapolis, for example, we think we were peaking out around 6% new inventory relative to existing. Mm-hmm. Markets in the Sun Belt were anywhere between 8 and 12. Right. Now we're down to 1%, for next 2026. But you have other markets in the Sun Belt that are experiencing negative rent growth, like Austin or Atlanta, and they're still going to be delivering kind of 4 to 5% of existing inventory. And so, what this next quote, it's that we're in a stagnant market, and I expect no major changes for the next few years. That means we're outside of this survive until 2025.
Yeah.
And all will be good.
Right.
Because everyone's realizing we're in 2025 and we're looking at multiple more years of more of this. Mm-hmm. Again, it may not be the exact same, but there's not going to be this inflection point that flips the script of the market and the economy, whether that's through a ton of distress or
right. You're not going to wake up one day and see a headline that's going to change the script of commercial real estate. If you're expecting that, you're going to be waiting a long, long time.
Exactly. Here's this chart I was looking for earlier. The access to capital. We mentioned this earlier, but again, just I think having it visualized like this, I think does resonate with me in our conversations of where, again, the first quarter of 2024 was much more difficult to raise capital for than, throughout 2025 and certainly near the end of 2025.
Yeah.
We were kind of really still in the middle of it. No one wanted to do anything. We knew that all this supply was being delivered. The rents really were slowing down, but also inflation was still really high. We had the 10-year Treasury that was getting close to 5% during periods of 2024. And all of that has not absolutely reversed, but it certainly has been moving in a more positive direction.
Fun chart to cross-reference with the pace of just interest rate changes, whether it's cuts or increases, just to see, I'm hoping it would be an inverse relationship. However, we were raising capital across this entire timeline. Mm-hmm. And so it's kind of interesting to take a look at that purple line in regards to Gray Capital's exclusive multifamily focus and just kind of plot our assets along this timeline and some of the headwinds in the capital raise process that we faced relative to the results of this survey.